In 2003, the SEC pursued a naked shorting civil action against Rhino, gave him $1 million penalty. Rhino blew up, Tom Beatty, and disappeared. The SEC gave the DOJ the tapes of Rhino talking to Refco brokers, giving instructions to short Sedona mercilessly. In October of 2003, Refco was subpoenaed, I think, by the Manhattan District Attorney. The investigation centered on Phil Bennett and Santo Maggio. Phil Bennett was the CEO, Santo Maggio, the president. Santo's roots were in the stock loan business within Refco. Every broker-dealer has a stock loan desk, and the business of loaning stock, as I've indicated, is at the heart of the whole naked shorting system. Because if you remember the explanation of shorting, someone has to borrow stock before it gets shorted, and so stock loan desk slippage is what permits naked shorting. So stock loan is the heart of the naked shorting system, and that's where Santo Maggio came from. 2005, what was the result? Gets pretty weird. In May, Refco revealed that they received an SEC Wells notice. A Wells notice is the SEC's way of saying, we're coming for you. Refco negotiated a fine. Maggio had a penalty of being relieved of administrative tasks for a year. I wonder if I can negotiate that fine with someone. Can I be relieved of administrative tasks? Yeah. A couple funny things happened in August. First, Barron was found alive in Austria by lawyers working on another stock manipulation case. Second, the SEC did what any good regulator would do when faced with a crooked broker-dealer acting on behalf of criminal clients and stock manipulation schemes to destroy small American companies. Did what any good on-the-ball regulator would do, and that is they gave the green light for a Refco IPO. Now remember that the P in IPO stands for public. It's initial public offering. So the SEC said that it would be a fine and right thing for this fine company to take $500 million of the public savings. In October, a Refco accountant, a new guy on the job, discovered a $430 million liability being kited on and off the balance sheet by a New Jersey hedge fund called Liberty, which I'll note has denied any knowledge that they were used as part of any improper scheme. Every 90 or 91 days, they took this liability for a day or two and got a fat fee to do so, and they thought that was just, good business, didn't see it as odd. So this Refco accountant went to the board, and the house of cards started collapsing. Out of nowhere, someone made an overnight, unsecured, $400 million loan to try to bail Bennett and Refco out. Who made such a strange, out-of-the-blue loan? A bank called Bank für Arbeit und Wirtschaft und Österreichische Postkasse Aktiengesellschaft, or BAWAG for short. It turns out to be a small, union-owned commercial and agricultural bank in Switzerland. Bennett was arrested, fleeing to Austria for a wine tasting. The DOJ got a wiretap on him and caught him. Bennett and Maggio were arrested, criminal indictments. Refco went bankrupt. So the money's gone. The Austrians are gone. Amro's back in Panama or Switzerland or whatever. Refco is being carved up and sold off. BAWAG turned out to secretly own somewhere between 10 and 37% of Refco. No one seems sure. They hit the skids. They turned out to be hiding their own billion-dollar hedge losses in trading accounts in Caribbean tax havens with weak banking laws. And Refco's biggest creditor turned out to be a Moscow hedge fund. All that remains of Refco is a greasy spot, but it is a special kind of greasy spot. It appears to be some lingering financial toxic waste. The U.S. Attorney for the Southern District of New York, Michael Garcia, held a press conference where he said that Refco left behind a $430 million liability of some kind. He wouldn't say what it is, but he said that it's something that floats and it's marked to market every night. Nobody in authority will say what it is. In fact, they're going to some lengths to keep that information quiet. But there are guesses going around that what that barrel of toxic waste holds is a huge number of FTDs in Sedona and other companies. FTDs that got leaked into the system by Refco that never got covered. Remember, these FTDs persist like radioactive waste. Why? because there's some grandma who has an account at Merrill Lynch who bought Sedona, but instead got these FTDs in her brokerage account. She thinks she owns Sedona stock. Her brokerage account says she owns Sedona stock. Somebody owes her that stock. Refco's gone, and Rhino's gone, and Amro's not to be found, and her savings are in Austria or Panama or Moscow, but grandma still has that stock, right? Well, we don't know, but let us pretend that this guess is right, that this barrel of financial toxic waste is a glob of 400 million of unsettled FTDs in Sedona and other firms. Let's imagine the impact of what that will look like on the financial system. There are, I said, 85 million Sedona shares, but there might be 100 million of these FTDs out there. Suppose someone had to cover by buying them in. Sedona is trading at 14 cents. 100 million shares at 14 cents would be $14 million. It's nothing. But only 50,000 shares of Sedona trade a day. It would take a long time to buy in 100 million shares. The first 1,000 might be at 14 cents, but then the next 1,000 are going to be 20 cents, 30 cents, etc. Short squeeze. Supply and demand would split. There would not be what the SEC calls an orderly market. Instead, the demand line would shift so far to the right that there would be no equilibrium price anymore and the market would crack. Now, is that fanciful? Is it some skies-falling fantasy? When Refco went under in October, this is what Bloomberg had to say. They spoke of the concerns that the Refco collapse would destabilize market. Here's a law professor saying that there's every sign that this is a systemic problem and Refco is one of the dots that needs to be connected. He spoke of the fears of a cascading effect that bankruptcy will trigger. Sunday Herald in Britain spoke of the gnawing fear that the Refco predicament might represent a sinister systemic risk. When they speak of systemic, in case you don't know, systemic means the global financial system. Systemic risk means the risk that the system will crater. That's what they're saying about Refco's collapse in Britain. Here's Dow Jones on the 17th, caught up with the U.S. Treasury Secretary Snow and Greenspan meeting with Chinese officials. While he wouldn't comment on Refco specifically, he says, many worry that the implosion of the biggest U.S. independent commodities and futures broker could trigger water fallout in financial markets. So this is Dow Jones raising that possibility. Here's the Harvard Business School insider discussing the meltdown of Refco and how strategists and portfolio managers have expected systemic event. Systemic. Here's more from mid-October, all these within a week or two of each other. There's the Wall Street Journal discussing. No broad market risk so far. Here's what Barron's has to say on the subject. I'm not kidding you. Barron's, while the world's financial press discusses the possibility of a systemic meltdown, Barron's, which is the weekly Bible of Wall Street, doesn't mention Refco. Months go by, it does not mention the Refco collapse. No mention whatsoever. A couple months went by before Barron's even mentioned in passing the collapse of Refco. That's pretty strange. And I challenge you, go to the Barron site and find the first mention of Refco's collapse. While the world was discussing financial system meltdown, it was more than 3 months before Barron's gave even minimal acknowledgement. Here's something else odd about the Refco bankruptcy. The last week of 2005, in a rare move, all the court filings in the action have been sealed by the court and are not available to the public. The judge also has agreed to hold all future hearings in the case out of the public eye. The secrecy surrounding the action is unusual for a civil proceeding. In court papers, lawyers from Milbank Tweed contend the secrecy is needed to prevent irreparable harm to the creditors and third parties. So, let's review Refco. It's a broker-dealer that was investigated for its role in naked shorting schemes on behalf of Panamanian money. CEO caught fleeing to Austria after he was caught kiting a $400 million liability with the help of a New Jersey hedge fund. got a late-night unsecured loan from a union-owned agricultural bank in Austria that turns out to actually secretly own 10 to 37% of Refco, and hit its own $1 billion of losses in the Caribbean, and its biggest creditor is a Moscow hedge fund. By the way, if you ever wanted to know what business looks like when it's all mobbed up, this is it. I'm not saying that they are the mob, but it looks to me like there's a blurry line between where international financiers stop and mob starts. Anyway, as far as the toxic waste goes, while the world press was speaking of systemic risk, and Barron's, of course, ignored it all, we know the investigation centered on the stock loan desk, which Santomaggio ran before he got indicted. We know the U.S. Attorney, Michael Garcia, held a press conference where he said the $430 million liability floats and is marked to market, but wouldn't say what it is. We know the judge sealed all the records. Well, what could that be? One thing it could be is a $400 million barrel of naked shorts in Sedona and other stocks, which would cost billions or tens of billions and maybe crater the system if anyone had to actually clean up.